everyone, and a very big welcome to you all. My name is Christina Morrissey, and it is my great honour to be your MC over the next 3 days here in Singapore. It's great to see so many familiar faces and a couple of new faces amongst you as well. Hello, and I know that this auditorium will fill exponentially over the next couple of hours and, of course, the next few days as well. So this is an event that has become the meeting place for leaders from across the global supply chain, from raw material suppliers, critical minerals companies, and, of course, our capital markets. So we're going to tackle some really big questions over the next 3 days, and we're going to give you some really interesting investment opportunities as well. And we're also going to try and create a space which is about serious collaboration too. There's a couple of housekeeping points I'd like to go through with you, and the first is our Wi-Fi slide. So if you'd like to connect onto Wi-Fi, those details are behind you. They are on the Solid program that we're giving out as well. There's also an app, so as part of our ethos to be as paper-free as humanly possible, then you can jump onto our app and you can follow everything that's happening to the event there as well. There's also a little rundowns on each of our speaker there, so you can see their credentials, and we have some supremely qualified human beings who are going to be taking to the stage over the next few days to share their insights and their knowledge with us. So while this conference is firmly focused on the future, day one is all about a metal that has been delivering for thousands of years. And we could not have planned this better if we tried, but the stars and the markets, everything just seems to have aligned for us, with gold smashing through that all-time high. So everywhere you look, it's front page news. When we jumped on the aeroplane in Perth, myself and my team, to come over, it was all that we were talking about. And if you have an opportunity to go in next door and have a chat with Gary, the gold man, as we colloquially know him, and have a chat with him, he invested in a rather large parcel of gold a couple of weeks ago thinking, gosh, this is a crazy price. And by Friday or Monday this week, he was thinking, my God, another great investment by me in gold. Gold is really, really important. So it may not be listed as a critical mineral, but it's absolutely critical to the way that investors protect and they grow their wealth in terms of uncertainty, as we all know. It's also playing a very quiet but an important role in tech and decarbonisation, especially when people are going off-grid. So yes, we're here to talk about the future, but today we're diving into that metal with that 5,000-year track record that's proving more and more relevant than ever. And to officially welcome us here today to Gold Investment Day and day one of the Tribeca Future Facing Commodities Conference of 2025, I'd like to invite Chong Lek Fung, who is the head of the family office for SGX Group, to the stage. Would you please make him very, very welcome, everyone?
Thank you, Christina, for the warm welcome, and greetings to all the delegates and speakers here who have come from around the world to this Tribeca Future Facing Commodities Conference. It is my honor to kick off Gold Investment Day with a short welcome speech. SGX has supported this event because we view mining and minerals as a very important part of the capital markets ecosystem. And it's with some pride that we've seen this event grow and become such an important leg of the Global Minerals Conferences Tour. So today what I'll do is I'm going to touch a little bit about Singapore and SGX, and I'll also talk about the Monetary Authority's Equity Markets Review Group, and then maybe a short segment on secondary listing, which is how SGX can be relevant to some of the issuers here. Okay. So before I dive in, maybe just a little bit about myself. So my name card today says family office team, but I've been at SGX for more than 14 years. So the joke I like to tell is if you stay at a company for long enough, if you don't die or quit, they just give you another additional assignment. And the family office is only my most recent additional assignment. When I joined SGX, it was to market for new listings, in particular for the mining, oil, and gas sector. But the market has evolved, and now when we look at Singapore, we talk about Singapore, It's really a global strategic hub. Why do companies want to come and do business here? Why would companies want to fundraise here? And why would family offices want to set up here in Singapore? So I'd like to tell a story about one of the other conferences I attended to, where I heard a gentleman called Ray Dalio, the founder of Bridgewater Associates, one of the global multi-billion-dollar hedge funds. And he said there are three reasons or three important aspects when family offices choose where they want to base themselves. First, you have to look at the balance sheet of the country. And indeed, Singapore is AAA rated. Second, you have to look at the convenience and the ease of living. And in fact, Singapore is close to half the world's population, and it has connectivity and dual trade agreements with many, many countries. And third is what we call neutrality, or the geopolitical leaning. And Singapore, in fact, is a neutral hub. So in that respect, Singapore is a strategic hub, and it can be for mining companies and investors globally. So maybe just a short word about SGX. People think it's the stock exchange, but it's more than that. When I joined SGX 14 and a half years ago, it was very much a cash equities market. But now, nearly 75% of SGX's revenue comes from other asset classes. So from fixed income, currencies, commodities, data, derivatives, all that is some of the multi-asset products which comprises SGX's revenue now. SGX has a global footprint of 19 cities, and the important or interesting ones include Tokyo, Beijing, Hong Kong, Mumbai, Gujarat, London, New York, and even Chicago. When it comes to exchange business, there's always a lot of partnerships between the various exchanges. We have derivatives agreements with the National Stock Exchange of India and the New Zealand Exchange. We also have securities arrangements with the Stock Exchange of Thailand for depository receipts, and also the Shenzhen Stock Exchange for exchange-traded funds. And we also have capital raising arrangements in place with NASDAQ, the New York Stock Exchange, Johannesburg Stock Exchange, and Tadawul in Saudi. So what makes the listings on Singapore interesting? Firstly, nearly 30% of all our listings are non-Singapore companies. It's a very high percentage when compared with the other companies, the other exchanges in the world. And there are many Asian global champions that have listed on SGX. For example, from within Singapore, there's Nanofilm and Olam. There's the Jardines Group. There's a number of Indonesian companies like Japfa Indofood. There's Chinese companies like NIO, the electric vehicles maker, and even brandy and whiskey from the Philippines. There's Thai companies such as Thai Bev, and quite a number of Malaysian companies as well. And here's a slide that talks about the kind of investors you find in the Singapore market. If you look at the section on the left, these are all the major global investors. You know, you've got Asian names like the EPF, Samsung, Asset Management, and Nomura. There's specific names, European names, and North American names. So if you just take a look at the logos there, you'll see a very wide global representation. But I think what's more interesting is the uniquely Singaporean names. So if you look at the right part of that chart, you can see on the upper section, there's those sovereign wealth funds, Temasek, GIC, 65 Equity Partners, which I'll explain in a moment, and also the Economic Development Board, or EDB Investment. There's also the wealth management sector, and I'd like to spend a few minutes talking about this because here's one group of investors, or one group of the market that has really changed dramatically and really changed the face of the Singapore capital markets. Now, wealth management has always been a segment that we've paid attention to, but in the last 4 or 5 years, we've seen a real uptick in the number of family offices that have set up in Singapore. In the year 2020, the Singapore government, the Monetary Authority of Singapore, announced that there were about 400 family offices that had set up. Now, these include those that have successfully applied for the various tax exemptions, currently the 13O and 13U tax exemptions. But by the end of 2023, they were saying that we've got nearly 2,000 family offices that had set up. So the number of family offices that have set up shop in Singapore has grown tremendously. So if part of your company's strategy is to get more family offices or ultra-high net worth on your register, or at least to profile your company stock to them, then this is the place for you. Maybe a short note on the secondary listing framework. SGX has a streamlined secondary listing framework. Companies that are listed on a developed jurisdiction, for example, Canada, the US, or Australia, they can do a listing on the SGX as long as they meet the admission criteria. But on a continuing basis, they just have to follow their home market listing obligations. So why do companies want to do this? Firstly, it's to get access to more investors. So if you want to widen your shareholder base and get access to more pools of liquidity, that could be one reason to do a secondary listing. Second is you may increase the trading hours for your stock, so this gives you better price discovery. And thirdly, it's cost efficient because you just have to meet the initial admission criteria on a continuing basis. You just follow the home market rules, so it's more cost efficient. Now, one thing I wanted to close off with is a little bit about what's going on with the Monetary Authority's Equities Review Group. So the minister announced last year in August that there would be a one-year equities review group whereby the group would review and come up with measures to enhance the Singapore market effectiveness. So it's supposed to take a course over the period of 1 year, starting from August and ending in August of this year. Starting in August of last year and ending in August of this year. But in February of this year, they actually made an interim announcement to talk about those measures that had been agreed to and which the market would start moving towards. And basically, they looked at 3 areas that they would make some enhancements. One is from demand, okay, or basically funds. Second, supply, or supply of companies. And third is changes to the regulatory regime. So very briefly, on the demand side, they announced a 5 billion Singapore dollar equity market development program. And the funds in this $5 billion equity market development program were intended to be deployed to non-index stocks. Okay, so this is an attempt to get liquidity out from the index and into the mid-cap and SME segment. Second is there was a tax exemption on fund managers' qualifying income if the funds invest substantially in Singapore-listed equities. So between point 1 and point 2, we expect to be some crowding in as the newly seeded funds start looking for investments of non-index stocks. And third, and interestingly, an adjustment to the Global Investment Program for family offices. So this is a large program. Excuse me. So for those family offices on the Global Investment Program, they would have at least $200 million in AUM, of which $50 million would be deployed into the Singapore capital markets. And the specific adjustment is that all $50 million was to be deployed to equities. So that's on the demand side. On the supply side, there's a number of tax rebates, including a 20% corporate income tax rebate for new primary listings and a 10% new rebate for secondary listings. And also a concessionary tax rate of 5% for qualifying new fund manager listings as well. So that would help encourage those companies as well, or give a benefit for companies when they're listed here. On the regulatory end, there were a number of points. Most interesting is they move from a nominally regime where it's disclosure-based to an actual disclosure-based regime. So this will also help to streamline the prospectus requirements and listing process, whereas previously both the Monetary Authority and the SGX would review a prospectus. Now only SGX would review it as well. So, I mean, this is the latest on the review group, and we'll have further updates later this year in August. And with that, I'd like to thank you for your attention. I'll pass the time back to Christina, and I wish you all a great 3 days of conference. Thank you.
Many thanks, Chonglang. Thank you so much for opening up our conference today. Now, our next speaker is an individual with a direct line to the central banks around the world. So when we were hunting for an expert to give us an insight into those recent central gold bank trends, he was the obvious choice. Xiao Kai Fan is walking up here. He is the head of Asia Pacific for the World Gold Council. He's also their global head of central banks. And for the next 15 minutes, his insights and his knowledge will help us to formulate our next bit of investing in this particular realm. Please make him very welcome.
Thank you very much, Christina. Good afternoon, everyone. It's great to be with you here today in Singapore. As mentioned, my name is Xiao Kai Fan. I'm the global head of central banks at the World Gold Council. I actually have another role. I'm head of Asia Pacific as well, but today I'll be focusing on the central bank side of my work because, as you all might know, the gold price has been doing quite well recently, and a big part of why the gold price has been doing well is because central banks around the world have been buying quite a bit of gold. So, just in context of how much gold they've been buying, this chart shows you net central bank gold purchases for the past 15 years. Why 15 years? Basically, before 2010, central banks were actually largely sellers of gold on a net basis. You might recall that we had an international monetary system called the Bretton Woods system that ended in the 1970s. After the end of that system, central banks no longer had an official use for gold, so they became net sellers for a number of decades, leading more or less up to the financial crisis in 2008, 2009. But luckily, for the last 15 years, central banks have been net buyers, with the last 3 years being exceptionally high levels of buying. So from 2022 onwards, central banks have bought over 1,000 tons of gold each year on a net basis. When you compare that to the decade that precedes it, you see that light blue line, which is the average buying across that decade, which is only about 400 to 500 tons. So in the last 3 years, central banks have been buying basically double the amount of gold that they had been buying in the decade leading up to that. Now, which central banks have been buying is also quite interesting. So these are all the central bank buyers and sellers of gold in 2024. The largest single buyer was the National Bank of Poland, followed by Turkey and India. Azerbaijan just leapfrogged China to be number 4 last year, and that's actually the Azerbaijan Sovereign Wealth Fund, I should say. But that's only because in, I think, late December, they updated their data. They had quite a bit more buying than they initially reported, which put them right ahead of the PBOC. On the selling side, you can see the biggest 2 sellers are the Philippines and Kazakhstan. These 2 central banks actually operate a little bit differently than many other central banks. They buy gold directly from locally mined domestic sources. So because they have basically inexhaustible access to gold, they can have a lot of gold in their reserves, and when the gold price is higher, they tend to start selling gold a little bit. Of course, Singapore is also on here as the 3rd biggest seller, but the sale was actually quite small, and it comes after, I think, 2 or 3 years of very strong buying as well. Singapore, I think, more than doubled their gold reserves in the last 3 or 4 years. But given the vast reserves of Singapore, it's still just a tiny drop in the bucket of their total reserves. I think it's about 3 to 4% of total reserves, so there's definitely room for Singapore to add more as well. I should caution, though, that the data I showed just now comes from 2 different sources. Where I said that central banks are buying over 1,000 tons of gold per year, that's based on World Gold Council estimated data. If you actually just look at the public information of what central banks have reported, so what they've either reported to the IMF or put onto their websites, it just constitutes the blue segments of these columns here, so what we're calling reported buying. If you subtract out the reported buying from what the World Gold Council is estimating that central banks are buying, you get the green parts of these columns, which is unreported buying. Basically, what we're saying is that for the last 3 years, central banks have been buying a lot more gold than they've been publicly reporting. And although we can't speculate which central banks have been doing so, it has been an ongoing phenomenon. And I think it's been backed up by the fact that the gold price has been doing quite well, with central banks often in the market to buy gold, especially during periods of dips in the gold price. So we do a survey every year of central banks and their views on gold, why they buy gold, why they hold gold. For the remainder of the presentation, I'll be walking you through some of the key findings of that survey. The most recent survey was actually last year's survey, so this was released in June last year. It's a little bit dated. This year's survey is currently in the field right now, and we'll be releasing the results in June of this year. So this question asks, if you hold gold, what are the relevant factors for your organization's decision to hold gold? Basically, why do you think gold is an important part of your financial reserves? Long-term store of value was the most highly cited reason this year. How we rank this is we add the highly and somewhat, so the blue and the green parts of the chart, and that's how we create the ranking. So long-term store of value is the most important reason. Performance during times of crisis was number 2. Effective portfolio diversifier and no default risk were 3 and 4. So basically it's pointing to the fact that central banks are concerned about inflation, but also concerned about uncertainty and needing to find a way to be able to diversify risks in their portfolio. You have to remember that central banks are very limited in terms of the asset classes that they can buy. Unlike most other investors out there, they often have specific guidelines, sometimes set in legislation, on which asset classes they can buy. Of course, the reason for why they invest is different than most other investors. They're not really focusing that much on return. They're trying to make sure that they have ample liquidity and that they're invested in very safe assets that can be deployed when needed, basically when they need to help to intervene in their currency markets or prop up financial markets during periods of extreme market instability. So if you combine all those factors in and you think, well, if you're a central banker, I need an asset that performs well when times are not good, when markets are rocky. I need an asset that's very liquid. And also, I'm very restricted on the assets that I can buy. Basically, I mostly buy highly rated government bonds, maybe a little bit of equity, and gold. So when you are limited and you have those criteria that you want to invest in, gold is probably the most sensible thing for a central bank to diversify into. It also helps that gold has been an asset class that's been around for thousands of years. Central banks have been using it for hundreds of years, so it's very familiar to them as well. So why I highlight this chart is not only to show you why central banks think that gold is important, but also to set up the premise for the following 2 charts. So this is the answer to that question in last year's survey, so the 2023 survey. And we've broken down the answers between 2 different pools of central banks. The blue dots are the average responses from advanced economy central banks, so Western central banks. The green dots are the average answers from the emerging market central banks. And you can see that in the survey from 2 years ago, there was quite a bit of divergence in terms of how these 2 different groups of central banks thought about gold. If you just take the box that's highlighted, for instance, where it says serves as geopolitical diversifier, about 90% of the emerging market central banks rank that as an important reason for why they held gold. Less than 30% of the advanced economy central banks thought that that was an important reason for why they should hold gold. And you can see that across all these different answers, there's a bit of a divergence, a spread between the advanced and the emerging market central banks in the survey from 2 years ago. Now, through the magic of PowerPoint, hopefully this will work. You can see that in this year's survey, or the most recent survey, that divergence has converged quite a bit. Much to my surprise, actually. I didn't expect the convergence to be so noticeable and so extreme. But basically, the advanced economy central banks and the emerging market central banks now have much more convergent views about why gold is an important part of their portfolios. If you just take the third one down, serves as geopolitical diversifier. Remember last year, there was a pretty wide spread between those two camps. Now, if you go back to this year, it's basically not just the same, but the advanced economy central banks seem to value that factor even slightly more than the emerging market central banks. And it hasn't really been the case where the emerging countries are valuing gold less. It's more that the advanced economies have caught up to the emerging markets in terms of how they view gold. There is still a bit of a divergence toward these factors on the right. For instance, domestic gold production. Very few advanced economies buy gold directly from domestic sources. But it does seem like for all the top-ranked factors, the advanced countries and the emerging countries now have very similar views of why gold is important. Now, I don't think you should infer from this that Germany and France are going to go out and start buying lots and lots of gold. But I do think that Western countries are now more focused on why gold is an important part of their reserve portfolios, and they'll probably treasure and cherish gold even more so. The next question is also a very important question. We ask survey respondents, do you intend to buy gold in the coming 12 months? So in the last survey, 29% of respondents said that they do intend to add gold, 68% said they don't intend to do any changes, and 3% said they plan to decrease their gold holdings. Over the years that we've done this survey, you've seen a steady increase in terms of the percent of central banks saying that they're going to buy more gold in the coming 12 years. I should also note that the number of respondents to the survey has grown steadily. I think in 2019 we had maybe 30 responses, and in 2024 we had 70 responses. So the absolute number of central banks that are saying that they're going to buy gold has also increased quite a bit. What I don't think you can infer from this chart, though, is the amount of gold that this would lead to central banks to buy, because of course, there's a very wide diversity of central banks who respond to our survey. We guarantee the anonymity of the responses. So these 29% that say they're buying or have plans to buy gold, they could be very large countries, they could be very small countries, they could be a mix. So, it's very hard to say exactly how much gold central banks will be buying. But of course, if you judge by their behavior in the last 3 years, I'd say that we're probably in for another solid year of central bank gold buying in 2025. Another important question that's come up recently is, where do central banks store their gold? Gold has become increasingly important in a very fractured and very uncertain geopolitical environment. The most common place for central banks to store gold are the Bank of England in London and the New York Fed in New York. And you can see that among the respondents here, 55% of respondents said that they do store gold at the Bank of England. 12% say they store gold in the New York Fed. There's actually more gold in New York than there is in London, so it's a little bit misleading in terms of the amount of gold being stored. But in terms of the number of central banks that say that they're storing gold in these facilities, 55% say they store gold at the Bank of England. A growing number of them say they store gold domestically. So 41%, which has risen from 28% back in 2019, say that they store gold at home. The BIS, the New York Fed, the Swiss National Bank, also very common places for central banks to store gold. But I think it is important to note that repatriation of gold, moving gold from London and from New York back to the home country, has been a growing trend that we've observed, not just since the Ukraine war started, but basically before that as well. Some notable public examples are the Reserve Bank of India announced that they are moving 100 tons of gold from London back to India, I think last year. A couple of years back, the Bundesbank, the German central bank, moved gold from New York and London and Paris, I think also back to Frankfurt. So there's been a growing sense that gold is an important asset and that it's not entirely immune from political risk, but it is more immune from political risk than some of the other assets that central banks hold, which I think is one of the underlying stories for why central banks have been buying so much gold in the last 3 years. Russia invaded Ukraine in 2022. Central banks bought over 1,000 tons of gold starting in 2022. I don't think that's necessarily a coincidence. I think, for one, the shock of the invasion, the fact that two industrialized countries in Europe can go to war in the 21st century, was a bit of a reminder that the world is not quite as safe as we thought it was. But after that, the sanctions imposed on the Bank of Russia on its foreign exchange reserves, I think, was a bit of an unexpected move by a lot of central banks around the world. Up to that point, some central banks' reserves had been sanctioned before, but they were either very small central banks or central banks that were in sort of a direct conflict with another country. Afghanistan and Iran are two examples. Venezuela is another example. Its gold at the Bank of England has been inaccessible by Caracas, but that's because the UK government disputes that the Caracas regime is the legitimate government. So there were no real usages of these sanctions against a country against which you had no direct military conflict and you didn't challenge the legitimacy of that government. Now, after the invasion, Russia's foreign exchange reserves were frozen by Western powers. And basically they remain frozen to this day, mostly in Euroclear in Belgium. Of course, Russia is the 5th largest gold holder at the official level, and all of Russia's gold is held domestically in Russia. And I'm not trying to speak on behalf of the Russian regime, of course, but I do think that because gold is a physical asset, because it can be moved to either your home country or a jurisdiction that might be friendlier to you, that might be a reason for why gold has become a lot more attractive for central banks around the world as well. Just closing here, going on to the last bit about where you store your gold, we also asked central banks, do you intend to change your custody arrangements in the coming 12 months? 2% said they plan to increase domestic storage, so move gold back home. 4% actually said they plan to decrease domestic storage, and 9% said they plan to diversify overseas storage locations. The vast majority have no plans to change, and 19% said prefer not to answer. So 2 plus 4 plus 9 is 15%, which is the highest level we've observed since asking this question of central banks saying they have plans to do something with their gold. They're going to move it somehow. It's important to remember that moving gold away from London and away from New York is not the only story. It's a bit of a two-way street. There are central banks that want to move gold out of their home country to a different place, maybe because they think the national security risks in their home country are growing. So just to basically reiterate what I was saying, gold has become much more important in an increasingly fractious and uncertain geopolitical time. I think central banks are looking more and more toward gold as a way to not just manage risks financially, but also manage risks politically as well. And where they store their gold will be an increasingly important factor in their consideration as well. I believe I will leave it there and return the floor back to you guys. So thank you very much.
Super interesting. Thank you so much. Very, very interesting. And remember that all of the presentations you see as part of this conference, you'll be able to go back and watch and look at it a bit more in depth. And you've got the beauty of having our presenters here over the next few days. So take advantage of that for those of you in the room, and make sure you go up and speak to them and drill into them even further and get some more knowledge and insights. All right. A couple of points to give to you before. Oh, look at that! You've snuck up on me, Mr. London. All right, Mr. London is going to be my guinea pig on how to do things correctly today, and he is in charge of a particularly impressive company, so I'm sure we'll be able to do that. So what I'm going to do with all of my presenters today is they've all got 15 minutes to present. At 2 minutes to go, I'll ring my bell, and at 1 minute to go, I'll stand up. We are, and I hesitate to say this, we're not quite as strict with time today because we've got some fabulous welcoming drinks for you all to enjoy today. So as long as we get to them by about 5:10, I think we will all be fantastic. And the calibre of our presenters today is, it knows no parallel. Now, I think as investors, there are some things that we like our investments served up with, and correct me if I'm wrong, but one of them would be, or both of them would have something to do with yield. So we like a little bit of a dividend yield, we like a little bit of a cash flow yield, and this gentleman here is serving up both of them on very, very large platters. So we're going to Ecuador, we're going to dig into London Gold, and this is our guide, Ron Hutstein. Please make him very welcome.
Thank you, Christine, and thank you, Tribeca, for the invitation. And I'm glad I'm not speaking right before drinks, because that would be really rough. I will be making some forward-looking statements. When you get a chance, take a look at our forward-looking statements. We celebrated our 10-year anniversary this year. 10 years in Ecuador, and I can remember doing financing with Lucas 10 years ago and everyone telling us how stupid we were to be going into Ecuador. Lucas had that vision, and now I want to tell you the story about the last 10 years, but also how bright the future is. This past year, we showed that Fruta del Norte is a Tier 1 asset. We produced over 500,000 ounces of gold. And it's an underground operation situated in southeast Ecuador. In 2024, we beat our guidance. We achieved our cost guidance. We're one of the few pure gold mines that is producing at less than $1,000 an ounce. Safety, room for improvement. This is one area my team knows that I'm not very happy about. But up to prior to this point, we had some of the lowest or the best safety statistics in the industry. And even though I'm not happy with these rates here are still some of the lowest in the industry. And remember, Ecuador did not have mining. Mining is new to Ecuador. So this has been a part we've really been focused on. We recorded adjusted free cash flow of $540 million, or $2.26 per share. We're now debt-free. We had over $750 million in debt when we started up, and we've paid the last bit of that off in this past year. We've now tripled our dividend. Our first dividend was in 2022. Last year, midway through the year, after we paid off the debt, we took that same cash and said, okay, let's start giving it back to shareholders. And then as the year continued to progress, we then increased it again to 30 cents per share. We've just done our second expansion of the plant. So originally we were 3,500 ton per day. Now we're at 5,000 ton per day. and also improving our recovery. And we're on track for 2023, and I'll talk a little bit about the guidance and the resources and how the future is still very bright for Lundin Gold and for our shareholders with our exploration potential. When we acquired the asset, we acquired not only Fruta del Norte mine, but also a land package of approximately just over 64,000 hectares. Fruta del Norte was found very quickly. Aurelian, then Kinross, then us focused on it. There's been essentially almost no work in what's considered to be one of the most prospective parts of the world for epithermal gold deposits. I mentioned our all-in cost at $875 puts us in the lower quartile. The ones you see to the right of us are the ones that tend to be copper as well, so they got a copper byproduct credit. And you can see here how our AISC broke down. Our first year of operation, we produced our first gold in November 2019. First 6 months of 2020, 3 of those months we were shut down due to COVID. Essentially, the country shut down. We were able to get ourselves back up and running, and since that time, have never had a 6-month period with negative free cash flow. And you can see this past 6 months, which really shows the benefit of now being debt-free. And with that, we're returning capital to shareholders. So as Christina mentioned, the dividend yield, we're now at 3.9%, which puts us as one of the highest in this space. And the board has instructed management to relook at our dividend policy. Our dividends currently are sustainable. We can continue to pay this dividend at prices well below $2,000 an ounce. That's what's part. Now what we want to see is what more can we do? So when we say review dividend policy, it's not a case of relooking at it to bring it down. It's what more can we do? But the future is still extremely bright. I talked about the increase in throughput to 5,000 ton per day, going to 5,500 ton per day in next year. There were 2 parts to this expansion. It was about a 40 million expansion. It was also to improve our recoveries. That was one area that we needed to do some more work. We put in some new technology, and our recoveries are already, we're seeing those improvements, and we're already operating at 5,000 ton per day. Here's our guidance for the next 3 years, at 500,000 ounces per year at sub 1,000 all-in sustaining cost. So what I like about it's not too hard to do the math right now at plus $3,000 gold. We're generating margins in excess of $2,000 per ounce. We've carried on a lot of exploration over the last few years in terms of our conversion and near mine, and I'm not sure what that noise is, but the knocking. What's that? Oh, okay. They're knocking to buy this. Where can we buy the stock? We've carried out a conversion drilling program, and we've now been able to. Our resources and our reserves are higher than they were when we actually did the feasibility study back in 2016. Our reserves, we've replaced the 2.4 million ounces that we've mined with 3.2 million ounces, just about 3.2 million ounces of new reserves. So again, our reserves are higher than they were when we did the feasibility study back in 2016. But the future, we just barely scratched the surface. This is just a graphic showing that 60,000 hectare land position that I was talking about. Fruta del Norte was found by Aurelian in 2006. Kinross acquired it in 2008. We started our near mine program in 2022. So all the drilling, all the exploration is focused on that little postage stamp on this very large land package. It's only this year with our regional program, we're actually going to start putting geologists, doing some airborne geophysics with the goal of identifying and putting forward some new drill targets in that very large region to the west of Fruta del Norte. But it's our near mine program that's really been the story to our success. This graphic shows really good history. The original drilling done way back in the early 2000s was actually done by Climax. Aurelian put this together in 2005, discovered in 2006 Fruta del Norte. You can see they focused on it. Then Kinross did conversion drilling, and then we acquired it in 2014. We did a little bit of exploration, but really had to focus on construction. It wasn't until we started doing regional exploration in 2021, and then we hired a new VP of exploration, Andre Oliveira, who said, guys, let's focus around the mine. So that's where our near mine program started in 2022. And you can see that last year we drilled just over 80,000 meters, the largest drill program ever around essentially that area. We put in our budget 80,000 meters, and I had a meeting with Andre on Friday, and our new budget is going to be roughly about 110,000 meters now for 2025. This is a good graphic of showing Fruta del Norte. So the gold you see there is the existing resource envelope. You can see our twin declines into the north part of the deposit, excuse me, and our new discovery, Fruta del Norte South. We currently have 15 rigs, a combination of underground and surface rigs drilling FDN East, FDNS or FDN South, Bonza Sur, and our new discovery, Trancaloma. This is our conversion program where we've added resources, drilling essentially, now this is the plan for 2025, to looking at that upper and that lower part, and then really focusing on this new area, Fruta del Norte South. Excuse me, Fruta del Norte South increased our resources by about 56%. It's all inferred, so our goal this year is to drill that out, to be able to bring that into indicated, and have part of that in the mine plan for 2026. This is just some recent results. These results that are shown here were not part of the resource estimate that we put out about a month ago. There's some pretty decent holes here of 8 meters at 174 grams per ton, 10 meters at 70 grams per ton. Again, these were not part of the resource estimate. This is still open to the south, open at depth, and we've started to hit some holes up here to the east, and as you can see, those veins look like they're trending to that east. So this is something that's very exciting. We may only have scratched the surface with FDN. This is a deposit that was listed up there, Bonza Sur. This is different again. This is a open, or at surface, running 1 to 2 grams per ton, only about a kilometer south of FDN, and something we're looking at putting out our initial mineral resource estimate by mid this year. This could be the next step in taking us from 500,000 ounces a year up to that 700 to 800,000 ounces per year by opening up a small open pit operation to the south of us. Excuse me, but I talked about our new discovery. We were drilling to the east of Bonza Sur to try to expand it. We started to hit some copper. At the same time, we had just completed some geophysics of the area. The first time geophysics, an IP survey, had actually been done here. Also did some seismic, and it showed a whopping anomaly to the east of Bonza Sur. And you can see here we've only put 5 holes in, 3 of which are shown here. And we're starting to hit some pretty significant copper gold mineralization directly from surface. There's one hole you see off to the right there where we say waiting results. We'd actually drilled that down to 400 meters, which was our standard depth. It ended in mineralization, some of the best mineralization that we'd seen in that hole. So we'd gone back in earlier this year and now completed that, and we're just waiting for the assays. This is a strong copper porphyry type target right beside Fruta del Norte. We all know, any geologists here know, that epithermal type deposits tend to be around the edge of very strong porphyries. FDN is arguably one of the best epithermal deposits in the world today. It had to have a strong engine, and this is maybe what we started to tap into. Our corporate structure, we have 2 large strategic shareholders, the Lundin Family Trust at 29%, Newmont at 32%, and then widely held. Why I'm really excited is a lot of the analysts have switched us to a hold, current stock trading around 44. But what you have to remember is the analysts they're not too good at looking at the future. Their models are based on our mine plan. So their models are based on our reserves. They're not based on the resources that we've added. They're not based on the exploration potential. The Trancaloma results, 0. Bonza Sur, 0. And the large exploration package we have to the west, 0. That's why the future is bright for Lundin Gold. This is what we focus on every day. Lucas Lundin, bless his soul, drove it into every one of us, and now his sons, Jack and Adam, are doing the same. Create shareholder value. We do that with 3 focuses and 1 strong foundation. Operational excellence. It's a great deposit. We can't allow ourselves to fall into that trap of great grades make lazy miners. Our team continue to focus on ways to reduce our costs and increase our throughput. By doing that, we're generating significant cash flow, which enables us to return capital to shareholders. As you see, we now have one of the highest yields, and fund growth. Growth through organic and inorganic. We are looking at things to acquire, but we know trying to duplicate FDN is going to be a challenge. We have 3 key words: patience, opportunistic, and disciplined. Fruta del Norte was identified by Lucas over a lunch in Toronto. Things can happen, and we are continuing to look for opportunities. And none of this is possible without that strong foundation of ESG. In a couple months, I will meet my 30th anniversary of working for the Lundin family. When I started, I was working for Adolf, Jack and Adam's grandfather. Most of my career has been working with Lucas. Adolf believed the reason he was in natural resources, at that time it was in oil and gas, was because it could change people's lives, transform people's lives. ESG has been part of our culture as a Lundin Group long before it became those 3 letters. And that's what's enabled us to have the great success we've been able to get in Ecuador. The future's bright, and we look forward to meeting with any of you that have any further questions on Lundin Gold over the next couple days. Thank you again, Tribeca, and thank you, Christina.
Thank you so much, Ron, for that presentation. I think, Scott, you'd agree with me, that embodies a big part of what it was when you were co-founding this conference to start with, these sorts of people who are leaders in what they're doing. To hear that you're already doing the ESG and everything way before it became a slide number 10 on the deck is so wonderful, so impressive to hear. Now, we are going to go to West Africa now. We're actually going to go across to where there's 3 fabulous producing gold mines in West Africa. We're going to learn a little bit about how to use the King's English correctly when we're in West Africa. We're also going to learn what a producer with $704 million in cash might be able to do for our investment portfolio. Would you please make welcome Stephen Foreman, Investor Relations Manager for Perseus Mining Limited.
Thank you very much. Thank you, Ron. That's a tough act to follow. Unfortunately, our CEO can't be here today. He's been seconded back to Perth. But I wanted to give you a very broad overview of Perseus Mining. We are a West Africa-focused producer of gold. We've been producing over 500,000 ounces of gold now for the last 4 to 5 years. We've got 3 main mines in West Africa. In the top circle, you can see we've got our oldest mine, which is Edikan in Ghana, which is producing gold for the last 14 years. Our second oldest mine is Sissingué, just up on the border of up in northern Côte d'Ivoire, which has been producing gold now for 6 years. And our newest mine, Yaouré, which is in the central Côte d'Ivoire, it's been producing gold now for 4 years. We've been consistently producing gold at 500,000 ounce level around just on our all-in site cost of about $1,050 last year. We have, as Christine mentioned, we have a $704 million US in cash on the balance sheet, in cash and bullion, along with no debt and $300 million US debt facility. This is a chart that we always like to show off, where we can see our quarterly production by mine since 2020, and you can see the increasing in production over the quarters, along with an increasing realised gold price. But more importantly, that middle line is our all-in site costs, and you can see how we've managed to produce gold at a steady rate, at a higher rate. There has been growth, but our cost base has remained quite steady. The financial metrics for the December half year were very, very strong. You can see our gold produced, this is for literally the first half of this financial year, 500,000 ounces of gold and an all-in site cost of 1,162. Both our production was at the upper half of our guidance, and our cost was at the low end of the guided range. We've got notional cash flow for the half of $300 million, and as I said, we finished the half with a cash and bullion on the balance sheet of $704 million. It's an increase of $117 million over the previous 6 months. Further financial metrics, very strong. This is half-on-half growth in revenues, up 20%, EBITDA 26%, gross profit from operations up 26%, profit after tax 22%, earnings per ounce up 25%. So all these earnings are produced in West Africa, and we're very proud of the progress we've made and the team that we have operating these mines. Cash from operations, gold mining cash is king, so this is where we've excelled in our half-on-half growth in cash from operations in the last quarter, particularly in our operating cash flow per ounce, just under $1,000, which is up 20% quarter on quarter. Something the local teams are very, very proud of. As I said to you, our growth in tangible assets finished the last half at $704 million with no debt and a $300 million undrawn debt facility. So the outlook beyond 30th of June, what we're planning on doing, our mission is to maintain a production range between 500 to 600,000 ounces per year. We've also got a couple of growth projects which I'll talk to. We bought a gold project last year from a company called OreCorp, which is listed on the ASX. We acquired that gold project, which is a large undeveloped gold project in Tanzania, which we're looking to go to FID. What's today? We'll probably do FID decision in the next 2 to 3 weeks, and that will be first gold production from Nyanzaga, which will be first quarter of 2027. So with $704 million of cash on the balance sheet, we always get asked what we're going to do with that. So we have our capital management framework with our targets and priorities. I guess the main pillars from this slide to take away from, we're looking to maintain balance sheet strength and resilience. We have, as I said, we've got $1 billion in liquidity at the moment, and this provides us the opportunity to share that cash bounty with shareholders. We've been paying dividends since 2021. And the end of financial year 24, we started a buyback. We're currently it was our maiden buyback of $100 million. We're currently a quarter of the way through that buyback at the moment. Just our dividend policy, you can see the growth in dividends for the last 4 years. We had our interim dividend, which was double what it was the previous financial year, and also the bottom graph shows you this is at 30th of June, our progress on our share buyback. So we have a lot of shareholders geographically based. Some people want dividends, some people looking for capital returns via buyback, so we tried to balance that approach. So just to highlight where this is our asset portfolio. As I said, we're looking at you can see the bottom right-hand side where the Nyanzaga Gold Project in Tanzania is based. We also have an existing undeveloped gold project in Sudan called the Maya Sands Gold Project that we bought 4 years ago. And we also, just thought I'd mention it, we haven't got a separate slide on this, but I always get asked about this. We have just under 18% of a company listed on the ASX called Predictive Discovery, which we own just under 18%, which has the Bankan Gold Project in Guinea. So a lot of the work that's being done around with $3,000 gold price, a lot of the work that's been done at looking at existing, growing the asset base, or growing the reserve base, I should say, that we have. And we're in the process of doing updated life of mine plans for all our 3 operating mines, which will provide that to the market in the next 2 to 3 weeks. And that'll give you an idea about the work that we're looking at, further cutbacks, A lot of the pits were designed when gold was trading at $1,100 an ounce, and we're looking at, if we raise that price, say, to $1,950, as an opportunity there to mine higher grade ounce or lower grade ounces, but still maintain a solid margin. One of the projects that has gone to FID at the end of last year, which will extend the life of Yaouré, our main mine, our predominant gold mine in Côte d'Ivoire, is the CMA underground mine development, which is the first underground mine project in Côte d'Ivoire. We've immobilised our mining contractor Burncut, which will be on site early next month. The plan will be the first portal cut will be approximately July this year, and we're looking to start producing gold from underground commercially by the beginning of our financial year 27, which is approximately a year from when we first do our first portal cut. So just to highlight to you in the bottom here, we've got our Tanzania project, Nyanzaga, which we own 80% of, which we acquired through OreCorp. We're in the process now of finalising our final investment decision. We estimate that project will cost between $450,000 to $500,000 US dollars to build. That's what we've guided towards the market. You can see where the project's located. We're sort of in the vicinity of where Anglo Gold and Barrick Gold are operating in the region. This is the first gold project that's going to be developed in Tanzania for I think the last 2 or 3 years. So the government are very excited by the fact and being very cooperative in helping us get this mobilised. So as I said to you, we're targeting final investment decision, updated life of mine plans, which will give you a guidance of how our production and costs look with the other life of mine plans, which should be out in the next 2 to 3 weeks. You can see that the schedule, we acquired this project sort of in the first half of last year, and we've been very, very busy on preparing, getting things organised to begin full-scale development of the project. There's been a lot of the larger items have been ordered, which take a long lead time. And as I said, we're targeting first pour in January 27. So our we've got our Sissingué mine and our Edikan mine are in the last 2 or 3 years of their mine life. And really what Nyanzaga is going to do is replace those ounces, those lost ounces from Edikan and Sissingué. So that's going to maintain our target production level between 500,000 to 600,000 ounces for the foreseeable future. There's a lot of work going into, we've had to relocate some of the locals. We had to build pretty much 80 to 120 new homes for some of the locals that were agreed to be relocated as part of the process. Some pictures there of what we've been very busy in the last 6 months or so. Another development project that we had, which would have been commissioned this year if things had have gone the way we thought they were. We bought the Maya Sands Gold project through an acquisition. We bought this project in 22. And unfortunately, there's been some civil war breaking out in Sudan. So this is a project where we're way north near the Egyptian border, but unfortunately it's very difficult to commit the capital that's required while there is unrest in the country. So this is obviously a watching brief. This would have been, if there hadn't been any civil war, this project would be starting to produce gold in the second half of this year. So this was going to be our first project, our first development project. So Nyanzaga is going to fill that void. In an ideal world, we'd build Nyanzaga, get that developed and take the development team from Tanzania and straight to Sudan to build this project, but we'll see how that goes. Certainly one of the tenets of Perseus is making sure that we have a social license to operate in all the regions that we're in. We have very strong community relations. It doesn't matter how strong you are, or it doesn't matter how good project you have, if you don't have the buy-in from the local community, well, then you're not going to get very far. So we've got a very, very, very strong push on our social license to operate. You can see there, this is for the December half year. Our total economic contribution to host countries is about $325 million US dollars for the first half. Full year last year, calendar year last year, our economic contribution was $662 million US dollars. Local employment, we employ very much locally. Most of our mines have got all the employees come from including a lot of the contractors, come from the local communities. In Ghana, for instance, there's 100%, it's all local. There's not one expat on our Ghanaian mine. We obviously prioritise procuring locally in the local communities, and we have a very strong safety record. You can see here the economic benefits in more granular terms for the last financial year, split between Côte d'Ivoire and Ghana. You can see that for the full year, the economic generated benefits were $735 million US, and that's distributed between, you can see, local purchases, employees' wages, taxes and royalties, and dividends paid to the government, and also our local community contributions. So, lucky last, our investment proposition. So, we are a reliable gold producer. We aim to target to produce between 500,000 to 600,000 ounces a year. We have a very strong focus on our cost profile. We like to think that we have been in the bottom 10% quartile of the cost curve. We have a geographically and technically diverse portfolio. We're not just all in one country, and adding Tanzania will be another step to diversify that jurisdictional risk that I think some people talk to for Ghana. That $704 million US allows us to fund all our development on balance sheet. We don't have to go to any third parties, and gives us an opportunity to also, we've got our, provide returns to shareholders. And those returns to shareholders will grow as we increase our cash balance. So with the addition of the Nyanzaga mine, we'll look to build our reserve inventory that supports at least a 10-year mine life of production at least above 500,000 ounces. We have a very, very strong development team, a very good focused operational team that's been working in Africa now mining in Africa for 14 to 15 years. And we feel that's where we feel we've got our, not so much our secret sauce, but our edge is operating in that region. And we have a very strong corporate mantra, is what we say what we're going to do. When we always promise, when we promise something, we usually deliver that. So that is the top-down view of Perseus. I did this presentation, my first go of it was 20 minutes, and now I'm down to 14, so I think I've done pretty well in cutting off 6 minutes. So I appreciate all your time today, and I want to thank the organisers and thank you all for being here.
Well done, Stephen. That was very, very impressive indeed. So I noticed that you did say Tanzania, though. So I'm supposed to say Tanzania? I'm not sure if that one will catch on. All right. We are heading off to New Zealand next. New Zealand historically has been one of those places where it's been a bit tricky getting a resources project up and running because, well, I think what we'll discover over the next 15 minutes or so is there's been some recent changes, recent economic reforms, and those reforms include fast-track approvals. And Santana is jumping up here on stage. They've jumped on this opportunity afforded to them by the New Zealand government. They've got a sizable gold resource that's ready to mine, and we're going to drill into it with this fellow. This is Sam Smith. Would you please make him welcome, everyone, the ED of Santana.
Thank you very much. So it's true, and last year we were on the conference circuit and we were playing videos, that's all we had, of Minister Shane Jones, the Resources Minister of New Zealand, who was promising economic reform through the introduction of this fast-track approvals bill. And every presentation I did to investors was met with the same question: do you think the bill would get up? And I kept answering, well, I think it's going to get up because that's what the government's telling us. And I'm pleased to say that in December, on the 23rd of December, when everyone was breaking for Christmas, the fast-track approvals bill was ratified into law in New Zealand. And our project, the Bendigo Ophir Gold Project in New Zealand, was officially identified and named in the bill, which basically gives us a very clear permitting pathway as a project of national significance. So I'll tell you all about it. So if you missed the elevator pitch on this company and this project, we've made the most significant gold discovery in New Zealand in over 40 years. In an area steeped with a gold mining history, over 8 million ounces has been pulled out of central Otago since the 1860s, and now in a country with a clear permitting pathway afforded by the fast-track approvals law. And it all came around at a perfect time for us, because to proceed into the fast-track approvals process, you need a pre-feasibility study. And we were just at that time in the life cycle of the project. We drilled out the Rise and Shine deposit, and we're entering into our PFS study phase. So it's just all come into place, fallen into place at the right time for us, and it's incredibly exciting. So let me tell you about the project. First, I'll locate you on the map here. We are on the South Island of New Zealand, 1 hour away from Queenstown, and about 90 kilometres away from the famous Macraes gold mine, owned by Oceana Gold. And one of only 2 Tier 1 commercial gold mines in New Zealand, the other one being Waihi, both owned by Oceana Gold. So you can imagine how exciting this is, not just for our shareholders, but for the government to see New Zealand's 3rd Tier 1 commercial scale gold mine to get up into production. We're in a semi-arid environment, and when one thinks of Queenstown, one thinks of the beautiful snow-topped Alps in Queenstown itself, or perhaps the stunning fjord land of Milford Sound. But it's not that. Where we are is rabbit-infested, depleted, beef and sheep country, privately owned freehold farmland, and we have agreements in place to mine with the station owner. So the image you're looking at now, and I'll go into the more specifics around the Rise and Shine discovery, but that's it in the gold bar. Just remember that trajectory and some of the topographical features on this slide. The Rise and Shine Valley to the south there on the right-hand side of the slide, an important feature because all of our discoveries have subcropped or outcropped in that valley, and that's because, as per the blue dotted line, there is a major regional fault structure called the Thompson Gorge Fault. Shepherd's Creek is also important. That's where all of our infrastructure will go, hidden away from the local community. But essentially, that is the project. That's the main event. But I'll zoom out now to the project area. You might remember that tenement shape on the location slide. There it is in the bottom right-hand side of that image. That little red square is essentially the project area you're looking at now. So about 10% of the broader tenure, and there's plenty of exploration upside. But that project area already 4 discoveries, and most certainly the main event is Rise and Shine. We call it RAS, over 2 million ounces, and now with a probable mining reserve of 1.15 million ounces on the back of our pre-feasibility study that we announced in November, which I'll go into. So those other satellite deposits, lower grade, fewer ounces, still over 100,000 ounces there, but they'll have a meaningful input into mill feed in the mine plan as we move forward. But certainly commercialising Rise and Shine is what we're trying to do at the moment. So let me tell you about this major discovery. This is a plan view looking down on the deposit. You can see again that blue line there, the Thompson Gorge Fault line, which basically transects the 2 different rock types, the TZ4 schist and the TZ3 schist. This is a blind discovery. I'll show you that in long section in the next slide. But looking down on the deposit, 450 metres wide mineralised zone, 150 metre wide high-grade core, and that's what we're going to focus on extracting. I'll tell you about that in a moment, and up to 45 metres thick in its thickest part. So it's, and traced 1.7 kilometres down plunge so far. So thick, long, wide, high-grade deposit that we are focusing on. Looking at it in long section, this is looking east, but this is a really good way of demonstrating the continuity. So our founding director, Kim Bunting, who's on our board, raised some money in 2021, put a drill rig up on top of that TZ3 light grey rock and drilled through 100 metres of blind cover to make this discovery. And every time he stepped out, down plunge to the north, he kept hitting it. So it was certainly a game changer for Santana. So looking at the cross sections now, in fact, I'll just go back. I'm going to show you cross section A, so you can see that dotted line there. I'm going to slice the ore body. We're going to turn it 90 degrees and look through it, so you can see how thick it is. And this is what's got everybody really excited about this project. As you can see there, up to 40, 45, 50 metres thick. That's 4 times the height of this ballroom, and of grades of 7, 8 grams per tonne. The last hole we put into this high-grade core was 42 metres at 8.5 grams per tonne, and that's not unusual, certainly in this zone of the ore body. And it's a flat-lying ore body, so all of those intercepts are near on true width. So it's a very simple geometry, very simple ore body to define, and will be to extract. Of course, all of that is only meaningful if we can liberate the gold. And I'm pleased to see this is probably the simplest part of the project is it's all free milling gold, 93% recoveries, high gravity component, low reagent costs, very simple flow sheet, simple CIL processing. So we put out a PFS in November, probably a bit premature. We needed to get something in place to lay the framework of the project to give effect to our fast track approvals application that we'll be submitting imminently. But what it showed us is that we had a large open pit going underground. So 8 years of mining at Rise and Shine in the open pit, and then 6 years of underground mining. And at recent gold prices, and you can see, and we went over 5,000 an ounce overnight, which is hugely exciting. But at 4,500 per ounce, this project has a net present value of $1.3 billion, multiples of where our market cap is at the moment. We'll build the project for $340 million, but I'll tell you about that because we are looking at a smarter way of staging the pit sequencing, and we'll reveal that through our PFS update soon. But on these metrics from the November release, we'll be producing gold at an all-in cost, not all-in sustaining, but including all of the capex at $1,880 per ounce, giving us a margin of $2,670 per ounce. So what that effectively means is the gold price could halve and would still have a really robust project. And so what that means is just really, really good metrics for banking, and all of the banks, we've been engaged with all of the big retail banks from Australia and New Zealand, and you know that it's an attractive proposition when you get those low-risk banks knocking on the door, because it's New Zealand, basically an extension of Australia. It's gold, so there's a strong appetite from the retail side in terms of the debt proportion of what will likely be a traditional debt-to-equity style financing of this project. And that's only half the story. Important to say, you'll see there in the top row, still 730,000 ounces at Rise and Shine in the inferred category. So obviously these metrics are wrapped around our indicated ounces, but still plenty more upside at the project. So this is just the beginning for us, just to get it into production. One of the reasons that it's such a low cost of production is the area. We are located in an area that is just blessed with infrastructure. You can see our project location there in the top right-hand corner of the slide, tucked inside the Dunstan Ranges, out of view from the local community, essentially being the town of Cromwell that has 8,000 people there, so a captive workforce all crying out for better jobs. We have access to fresh water, great for processing, low-cost hydropower from the Clyde Dam nearby, and a bitumen road on State Highway 8 that goes right up to the turn-off to the project. So a lot of that sort of stuff. There won't be any FIFO headaches, no catering contracts, no airstrips. So very low cost from an OPEX situation, and a bit of a win on the CAPEX as well. But it's all about the Fast Track Approvals Act now. Again, we are officially identified as a project of national significance, and why wouldn't we be? Potentially $1 billion of taxes and royalties into the government coffers over the first 10 years of production. So essentially, the doors open for fast track submissions in February. We are very, very close to getting our application in, possibly in the next 4 to 6 weeks. We'll keep the market updated on where that's at. But prescriptive under the fast track approvals law is a 6-month permitting timeframe. So what that means is we could be funded and approved and buckets in the ground ready for construction by the end of the year. So it's a very near-term construction proposition. So what have we been doing since the PFS in November? I mentioned before that we're restaging the pit, and we've essentially, before I get to that, it's the next slide actually, essentially we're preparing for mining. We've been redefining the high-grade domain that I showed you before, just keeping it as tight as possible so that we don't step outside that wireframe when it comes to mining, so that we tighten up and reduce our stripping ratio. So we drilled the eastern margin of Rise and Shine, because on the eastern margin that sits underneath Battery Hill. You might remember it from the third slide where I showed you the actual landscape. So we don't want to step out to the east, so we've tightened up that eastern wall, redomained the high-grade core. There's over 1 million ounces just in that high-grade domain, and that's running at about 4.5 to 5 grams per tonne. Anything outside of that we mine as a consequence in our LG or lower grade domain, which is still 2 grams per tonne, we'll manage on the way through. But there's just an acute focus on extracting that high-grade core, which gives effect to the pit staging exercise I mentioned. You'll recall that the CapEx bill on this project is $340 million. Inside of that is a $120 million pre-strip. We weren't super happy about that, so we're going through a new pit staging exercise, and we think that we can get that number down. So essentially in the PFS release in November, there was 12 million cubic metres pre-strip at $10 a cube. We think we can do it for 8 million cubic metres. You can do the sums yourself. But essentially, our PFS update that we'll release in about 6 weeks will factor in the new pit staging and some refinements in the process plant. And we're really excited about that. And we've got the team to do it. Just a quick look at our board. Peter Cook, behind companies like Westgold and Metals X. He's been involved in a number of gold developments. Damien Spring, our CEO, lives half an hour from the project. He's on site right now getting this permitted. Kim Bunting, he's the geologist that discovered Rise and Shine. Emma Scotney joined us a couple of months ago, sitting on the De Grey board, so a wealth of experience there. And Craig McPherson, our co-sec and CFO. We've got $56 million in the bank. At the cash burn at the moment, we'll get to FID at the end of the year. We'll probably still have $40 million in the bank, so super well funded. If you want to buy this stock, you'll have to get it on market at the moment, fully funded to FID. So we've got a high-grade, high-margin project of national significance named in the Fast Track Approvals Act with a very clear pathway to permitting that will see us into construction by the end of this year. You know, I keep thinking about other projects that already have a mining permit and a CIL or processing plant sitting on the side, and they're trading at multiples of where we are today. So on any peer value comparison, there's a lot of value to go once those major catalysts fall into place, and therein lies the opportunity. Put us on your watch list.
That was a very abrupt end, sir, but a fabulous, fabulous talk. Isn't that interesting, though, the difference that little change in economic policy could make potentially for them and for us as investors. Now, believe it or not, in Australia, we have these things called barbecues, and often at barbecues we have little discussions, and I was at one recently, and at our barbecues we have these interesting little games where it is, tell us the company that you believe we should invest in. Give us your pitch. And on Friday, at this barbecue, the company that was put in front of me and some of my friends was Orezone. I thought, well, that's really interesting because I have got the fellow that's in charge of that speaking at a conference that I'm doing in Singapore next week. So tell me about it. So they went on about because it's not even listed on the ASX yet, is it? But there's plans. There's plans. So they were telling me all about record revenue, net income in 2024, and they were telling me about some really remarkable milestones and also plans to accelerate, I think, stage 2 hard rock expansion. I thought, wow, this could be interesting. So I, like you, I'm going to take a seat and listen with keen interest. Would you please welcome Patrick Downey? He is the President and the CEO of Orezone Group. Please make him welcome.
Thank you very much, and hopefully I can live up to all the good hype there. That's great. Yeah, so Orezone has been a really evolving story over the past 5-6 years, but really this is the transition year for the company, and I'm really looking forward to describing that for you. Forward-looking statements I encourage you to read at your own time. So we are in Burkina. We're right beside WAF. I'm sure a lot of you guys know West African Resources. They're a $2.7 billion company. We're a $500 million company, which is why we are looking to list on the Australian exchange. It has been a great place to do business. We have a very, very large local shareholder who owns 20% of the company, bought it at a premium to market, one of the most wealthy guys in West Africa who lives in the country. It's a very supportive mine jurisdiction. There's been 16 mines built and a 17th coming on now with Kiaka, WAF's other project. And we will be the next big expansion in the country. Great infrastructure. I go there about 6-7 times a year. In fact, I'm leaving here to go there right after this. And we fly in, drive on a 4-lane paved highway, and we're about 5 minutes off the highway. So excellent infrastructure, water supply, power, etc. So great place to run a very profitable mine. We built the first plant which is 100% oxide. It'll go for about 14 more years based on current reserves. We do intend to expand that in terms of reserve base. We built it on time, under budget. We have our own build team. They've been with me now for about 5 mine builds. We've built mines together in South America, Canada, etc. So we have our own team. We do use consultants. We use Lycopodium for the design, but we look after everything else ourselves. That has been running for 2+ years. It was built at 5.2 million tons per annum. We're currently running it at 6. And we've got an excellent safety record. I'll show you that in a moment. I think we've got probably one of the best safety records in the world. So the stage 1 of the hard rock has been built right now. We'll be finished in Q3 and ramping it up in Q4. And as Christine said, we're actually bringing forward the next stage. We have one local debt provider. They're from Burkina, but they've got branches in 11 West African countries. No hedging, no gold prepays, no fancy derivatives. It's a 8.5% interest rate. Very, very simple to deal with, low covenant light, and so we use them in country. So we borrowed another $37 million from them, so we're fully financed to build this next stage. And one of the critical things about this project, the previous guys who had it were looking to build a heap leach. It wouldn't have worked, actually. It would have been a technical failure, but that's besides the point. But they did define one of the largest reserve footprints in West Africa. This is a 14-kilometer footprint. Most orogenic mining systems are developed within a 4 to 5 kilometer footprint. This is reserve defined to 14. But we've got 2.4 million ounces of reserves done at $1,500 gold to an average depth of 38 meters. So think about that. So 2.4 million ounces to 38 meters. They weren't looking at the hard rock. We are drilling it now again. We're very excited about that. Our target is to get to 10 million ounces. Right now, the resources are around 5 million ounces at $1,800 gold to an average depth of under 70 meters. So you can see where the real upside is here. Fantastic year. We've hit guidance 2 years running now since the start of the operations. We had record net income and record earnings per share last year. Gold sales of 119,000 ounces and all-in sustaining costs of $1,450. Really went up with the price of gold, with the royalties that added to the actual all-in sustaining cost. 0 LTIs for the past 3 years, which includes construction. So I want to say that again. We've got over 1,000 people on this site, 0 LTIs in over 3 years now, including the construction of one mine and the construction of a second expansion. 2025 is really a transformational year, but just to give you guidance, it'll be around the same as 2024 with roughly the same costs. So we will be doing around 9 to 10 million of sustaining capex. Growth capital, which is putting in a standby power facility. We are on the grid, but there are power interruptions, so we are putting in a standby grid which will service the hard rock and the oxide. And we're also doing the hard rock expansion, which will spend about $75 to $80 million on this year. So this will be the last real growth capital part of the company. The rest will be expansion or sustaining. So as we said, stage 1, which will bring us to 2.5 million on the hard rock, so that'll be 8 million tons per annum total with the hard rock and the oxide. That will bring production at the end of this year to a run rate of about 180,000 ounces a year. We will make a decision on announcing the stage 2 once we do the ASX listing. That will bring us to around 240,000 ounces a year by the end of 2026. All-in sustaining costs we expect to be between $1,200 to $1,250 at that time, mainly due to grade, and also your G&A will be spread over more ounces. So where does that leave us? Obviously, we'll be one of the lower cost producers and one of the largest mines out there in terms of a single asset company around the world, really. And you can see where our growth will go to. It'll go from currently around 118 to 120 to 180 by the end of this year to 250 by the end of 2026. This is what it looks like. The grey in the background is the existing oxide. The one we're building there, the coloured one, is the hard rock. The front end, which will be built for $5 million, will be the jaw crusher. We're not going to build 2 jaw crushers, so we build one right. We put the capital in for that right up front. The SAG mill is on site right now. We're starting to erect the CIL tanks. We're about 2 months ahead of schedule right now. We're right on budget. So you'll expect to see that coming on stream by the end of Q3 of this year. And we expect to exit 2025 at that 180,000 ounce a year run rate. This is what it looks like. We built the oxide in 2021-22, commissioned it and had it up at full throughput within a month. So it just sort of goes to show you how well it was designed. You can see the tailings in the background. We're doing a big expansion on that. And in the foreground is the stage 1 hard rock. We've poured a lot of the concrete, probably about 70% through the concrete pours already. The SAG mill raft foundation is poured. The piers are now being poured. The dump pocket and the jaw crusher, which is the biggest part of the concrete, is well in hand. We're probably 2/3 of the way through that. We're starting to erect the CIL tanks. All that concrete is done. So the structural mechanical piping contractor is there now, so you'll see in the coming months that will start getting erected, and the steel work is arriving on site for the top of tank steel work. SAG mill is there and will be starting to erect once we finish the concrete plinth pouring on the SAG mill foundation. So all well in hand and all on budget. So again, we do this ourselves. We look after it ourselves. It's our own team. We manage it. We look after it, and so it's no third parties doing this. So how do we get to 5 million tons? Well, it's pretty simple, actually. We had a ball mill. We've already identified it. It's the sister of the existing SAG mill. They were both brand new, out of the box, never used. Some of you may be familiar with Red 5, King of the Hill. There was 4 mills bought for a project in North America. They bought 2 of them. We bought the 3rd one, and we have a ROFR on the 4th one. So we'll start moving that into site here in the next few months. 4 additional leach tanks, which are exactly the same size as the current ones. We'll add a crusher and an oxygen plant and a thickener. So that'll cost about 90 to 95 million. We will have some upgrades to the gold recovery circuit. We'll add another elution tank and an acid wash tank and a couple of more electrowinning cells, because obviously we're doubling our gold production. So we've already done an estimate on that. We'll refine that for the board and hopefully get approval in the next 2 months to go ahead with that. So we'll start constructing at the end of this year. That also allows us to keep the contractors on site. We were originally going to build this in 2028, coming on stream in 2029. So we'd have to remove the contractors, bring them back on again in 2028. By doing it this way, we'll be able to keep them there and save some money on that mob demob. So we're pretty convinced that we'll be doing that this year. Everybody talks about ESG and stuff like that. So a couple of key things about that. We've got 97% Burkinabe workforce, only 4 expats, one of which is the security manager. So very, very much a local company. The bank is a local lender. One of its first parts of its due diligence was, and the owner of the bank said to me, was, you can go back to Canada. I live and work here in Burkina. So if we're lending you money, you better have the community on your side and all that sort of thing. And that's been a great success for us. As I said, we've got a large local West African fund who invested at a premium $50 million into the company. So that's a great testament to how we do our business, that one of the local guys comes in and invests in Burkina $50 million. And, so you've got really political risk insurance in that regard. I go there probably 6-7 times a year. Most of the local guys know me extremely well. I do truly enjoy, as Ron Honstein said earlier on, changing people's lives. And we do that as mining companies, and we should really talk more about it, how we do change people's lives, businesses, etc., education, opportunities, housing, water, power. So those are the sort of things that did not exist before we came here. We're really excited about the exploration. As I said, prior to 2017, when I came on board, they were looking at a heap leach. We're now looking at a very, very large open pit system. It's only drilled down. There's been, I think, I can't remember, but probably 3,000, 4,000 holes on this. Only 38 have been drilled below 250, 0.1%. has been drilled below 250, so still wide open. I'll show you section AA and BB for two different reasons. AA is proof of concept below that the system still exists. We took big step outs here. You can see the dark blue is the reserve pit. Average depth there is probably 40 meters. It does go a little bit into the hard rock. You can see the resource pit in the light blue at 1,700, slightly below that, but not much. And then we took these large step outs below it. The first hole we did was 200 meters below the reserve pit, and we hit, I think, around 1.64 grams over 50 meters below that. So you can see what we're hitting. So with 12 holes, we've expanded this down 200 meters and along another 650, just in one section alone. Now, we don't expect to do that along the whole 12 kilometers, but we only need to do it in 3 or 4 places, and now you're sitting on a 10 million ounce deposit. It's pretty simple to see. What we're more excited about was a recent discovery, P17. We discovered it just after I came on board. I'd rather be lucky than good. It wasn't discovered by us. It was discovered by the local artisanal mining groups. It's a different rock type. It's a granodiorite. It's a different system. It's folded. And you can see the grades that we're hitting here, and they're down chutes. We think this is another underground target. The pits there are less than 100 meters. Excellent grade, still wide open, and we're drilling brand new targets on the property because of this. We're really starting to open up the structural understanding of this deposit, and we're drilling our first new target. In fact, that's what I'm going to site to see. We have drilled it. No results back yet, but I think we're quite excited about what we're seeing. And this is going to open up the whole exploration. Our next door neighbour, WAF, was generally the same sort of grade as us until they hit M1. And M1 is a very, very high grade, only about a 40-meter strike extent going down vertically, but it's the juice of the system, and we're pretty confident we're starting to see the same thing now. So we're very excited about our exploration. This year will be the biggest drill program we've done since I came on the property in 2017. So, we expect that we will likely expand that beyond the 30,000 that we have. So we're going from 118 to 180, and then we'll go to 240. It'll be off that chart. You can see where our market cap is versus our peers. We're on the Canadian exchange. And you can see our daily traded value versus on the TSX, Africa versus the Americas. And why are we going to the ASX? Because you can see what they trade. West Africa, and our neighbour, trades our annual total value in 6 days. And they've got a market cap of 2.7 billion. If you just put us as a peer with our production and our costs, we should be trading at over $2 down there. So that's why we are listing. So and they understand the business very well. So it'll be a transformational year, 2025, ASX listing hopefully by mid-2025, and then full steam ahead on the expansions. Thank you.
Thank you very much, Patrick. Now, for those of you who are wondering, I'm not allowed to come over and stand in this space here when our presenters are speaking because, of course, it's all shown and recorded for our ASX back home. That was a very interesting speech. Wish you'd been at my barbecue. All right. Now, you remember at the very start of this afternoon's presentation, our gentleman from London got up and said that people told him that London was perhaps a little bit crazy for going into Ecuador. But he's proved them incorrect. And as we all heard and saw, it's now a very well-respected, multi-billion-dollar business. So I suppose the question is what if London isn't an island? What if there's more riches out there in Ecuador to unlock for ours? What if our next company on stage intends to unlock those potentials with a near-term development opportunity with a significant gold resource and development and feasibility studies underway? Would you be interested in adding this to your portfolio, having seen what London has achieved? Well, this is Melanie Layton. She is a very passionate geologist. She is also the CEO of Titan Minerals, and that is the company next up here to sway your investment interest. Please make her very welcome.
Thanks, Christina. You're right, very excited to be presenting the opportunity of Titan Minerals, another company that is in Ecuador, and very much looking to, I guess, emulate the success of Lundin Gold and their Fruta del Norte operation, and also other peers in the audience, Sol Gold, and the discovery success that they've had with their Cascabel project in the north of Ecuador. So certainly Ecuador represents a massive opportunity in terms of a significant lack of exploration, a very immature in terms of a mining sense, but in geological prospectivity, I mean, for Ecuador, you know, the Andean copper belt runs all the way through Chile, right through to the north into Colombia, and Ecuador represents a screaming gap and that opportunity, and that's what we are there to uncover, I guess. So just touching on our projects, we have 4 large-scale projects in the south of Ecuador, the Dynasty Gold project being our most advanced asset, and we've got 3.1 million ounces of gold and 22 million ounces of silver established in resources there. And then outside of that, our second most advanced asset is our Linderos copper project, and we were very pleased to have done a joint venture and earn-in agreement with Hancock Prospecting subsidiary company Hanrine late last year, whereby they are earning up to 80% of that project by spending up to $180 million Australian, you know, by doing all of the drilling and development studies and reaching a decision to mine. So clearly shows, you know, what they look to be a significant value in a project that, you know, we'd done sort of 3,000 to 4,000 metres of drilling in that project. We demonstrated, you know, good wide copper porphyry mineralisation there, and they can clearly see the value in that, and we're very keen to do the deal and get on and do the drilling. In fact, they're doing a 10,000 metre drilling campaign right now at that project. And so I will take you a little bit more further through the projects. But I guess, you know, the other opportunity, like I said, for us, it's Ecuador. We found the government to be extremely supportive in Ecuador. They do see mining as a big part of their economic revitalisation. And we're seeing a number of incentives in terms of, you know, low tax rates and fast permitting and the like in country. So, you know, certainly we also believe we've got the management and the technical capability in place to, I guess, advance and develop our projects. And there's a significant opportunity still to grow what we've already established in resources at Dynasty. So that 3 million ounces, we believe, could quite conceivably become 5+ million ounces of gold. A little bit on this corporate snapshot, I guess. Market capitalisation, roughly around $110 million Australian. So you can see from, I guess, the resources that we have contained and delineated so far at Dynasty and the joint venture deal that we've, you know, executed at Linderos, there's a, you know, quite a disconnect there. But pleasingly, as you can see from, you know, our trading, I guess we're seeing quite increased liquidity in recent months, and obviously the gold price is helping that. But I do feel that we're starting to see a little bit of that, you know, the capital markets and the equity being somewhat redeployed from the majors, you know, down to those developers, you know, and emerging developers and explorers. So, you know, I think we're really well positioned. We did quite a large funding late last year, a $20 million raise, of which we still have, you know, the bulk of that at this point at the end of this quarter. Tribeca Funds being one of our major shareholders, owning close to 15% of our company as well. So, you know, clearly well supported by a number of major shareholders and some high nets that have been with us for several years now, and, you know, certainly are very supportive of our strategy in Ecuador. So a bit more on the Dynasty project itself. Very large resource, clearly contained within a 9-kilometre long epithermal gold corridor. Mineralisation extends from surface. The low grade, or the component reported above 0.5 grams per tonne, is 3.1 million ounces of gold at 2.2 grams per tonne gold. And let's not forget the 22 million ounces of silver at a little over 15 grams per tonne silver, extending from surface down to a depth of about 350 metres. The bulk of that mineralisation is held within the top 100 metres, so more than half within the top 100 metres. and more than 80% within the top 200 metres. And of that, there's a high-grade component as well. 2 million ounces of that gold and 13 million ounces of that silver is, at a grade of 3.8 grams per tonne gold, 24 grams per tonne silver. So very high-grade resource extending from surface, and clearly, less than half has effectively been drilled, we believe. So a lot of opportunity to grow that resource both laterally and at depth, and that's currently what we're doing right now. We've got a 10,000 metre resource growth drilling campaign underway and targeting a resource update for mid this year. A little bit, more understanding of the resource distribution itself. You can see the graph on the left there shows the, the metal endowment, the gold and the silver and the distribution, and clearly, below that 200 metre mark, there's a real, low amount of resources, and that's largely a function of the lack of drilling, below that depth. The cross-section on the right there shows the, the epithermal gold vein-hosted mineralisation. And I guess the bulk of the resource has been drilled on an 80 by 80, in some areas 80 by 40, and down to a 40 by 40 in some areas. So we're sitting at close to 40% indicated and 60% inferred at this point in time. But what we do see from our infill drilling, where we do complete that, is that we tend to find more mineralisation within what we know. So we know with our resource conversion drilling, we will improve strip ratios and most likely improve grades and ounces within those areas as well. So good opportunity within what we know also. Some of our latest drilling results were returned just in the last few weeks. It's a little bit busy, that cross-section, but what I'm showing is current resources in that dashed black outline. We've got the indicated resources at the top, followed by the inferred below that. And new drilling intersections, more than 150 metres vertical below, which are intersecting, 5 metres at, 5.5 grams, within 17.5 metres at, 2.5 grams. So clearly a very well mineralised system that continues at depth, far below what we know. And I guess the opportunity for us to target more of that higher grade, really robust, wide mineralisation to, build out that resource inventory to that plus 5 million ounces, and to sustain what could be really quite a robust, long life, gold mine targeting, 150,000 ounce per annum production profile. But we won't put, a preface too much on what the mine could be, because I think, realistically there's a lot more discovery to be made through our exploration at the project. But we do like a little bit de-risking, and we do like to know that there's optionality when it comes to processing and mining an ore body. So I won't go into the detail too much on the metallurgy, but what I will just draw your attention to is that we're achieving recoveries in the high 80% gold, 87% gold via a standard cyanide leach for the oxide component of the ore. And then when we get to the sulphide or the fresh component, we're getting low 90% recoveries, via, again, conventional, processes. And in this part of the world, Ron from London didn't sort of touch on too much detail, but effectively what they're doing with their ore body is, crushing it, grinding it, floating it, producing a concentrate and selling that concentrate. So we have that option available to us, or we also have the option of further, processing that concentrate on site to produce, doré bars, if we choose to go that way as well. So I guess the point is optionality and really high recoveries being achieved either way we go. So at Dynasty, although we call it the Dynasty Gold Project, there are a number of copper porphyries that sit within the project as well. And as you can see from the image on the right, there's the Calaman porphyry to the southwestern corner, the Kohler porphyry effectively in the middle of that epithermal gold corridor, and the Giselle porphyry off to the right-hand side or the eastern end of the project. And, again, pointing to Lundin and what they're doing at their Fruta del Norte project. And geologically, we know that epithermal gold deposits, the heat engine and the source of the mineralisation generally is those copper porphyries. So we know that they're in close proximity. We've been able to demonstrate that they're here effectively from surface. We've seen it in our soil geochemistry. We can see it in our mapping. The only thing we haven't done here is drill it yet. So once we've completed doing our resource growth drilling, which is focused on the gold at Dynasty, in the next month or 6 weeks, we'll be sending the drill rigs across to these copper porphyry targets and testing what the opportunity could be, I guess, to backfill the mine life at this project, or could really greatly, I guess, transform the economics or the focus for this project. Because if we can find a large-scale, copper porphyry here, that'll be a real game changer for this project as well. So moving on to the Linderos copper project, very pleased to have secured Hancock Prospecting as our partner. They've been very active in Ecuador for at least the last eight plus years in their own right. They have their own projects. They've invested in excess of $100 million US in their own projects in the north of Ecuador. They've also entered into other joint venture exploration agreements with INAMI, which is sort of the mining arm of the Ecuadorian government. So clearly they're very active in Ecuador, and clearly they have aspirations to be a large-scale copper miner in Ecuador. So they see the opportunity, and they're being very, I guess, proactive about that. So our, joint venture and earn-in deal with them comes as no surprise that they are actually being very proactive at getting on with it. So they've earned their first 5%. They've paid us $2 million, US $2 million in cash. They are partway through their 10,000 metre drilling campaign. We've got results coming from that very soon, and I believe they will complete that by probably May this year. And at that point, they will have earned 30% of that project, and then they will go into an additional 15,000 metres of drilling to then get to 51%. And I think they'll probably do that by the end of 25 or early 26. So it gives you a sense of their, I guess, ambitions to get on with things at Linderos. And I guess, we were able to do that deal because the technical capability of our team, the well-placed drilling that we had put into the Copper Ridge prospect at Linderos, which demonstrated grades of and intersections of 308 metres at 0.4% copper equivalent, with some higher grade intervals of 0.5, 0.6% copper there. So copper mineralisation from surface, opportunity for higher grade mineralisation within that, a 1 kilometre footprint at surface defined by geochemistry and mapping. In fact, a 2 kilometre footprint defined by geophysics and an IP survey that we did in July last year. So all the hallmarks of a very large-scale copper porphyry system there. And clearly we are fully funded by Hancock and not having to pay anything until they reach their 80%. Copper Duke is another one of our copper projects. I won't spend too much time on it. I don't want to bamboozle you with our projects that we do have. But again, another large-scale copper porphyry project, 7 kilometre long porphyry alteration footprint, all the hallmarks of a tier 1, global porphyry system as identified by the geochemistry, age dating, multiple fertile intrusions and mineralisation styles. And again, look, we intend to get out there to Copper Duke to test these drill targets in the second half of this year. Ecuador itself, look, I already touched on it, the government being very supportive, and look, they do see mining as a large part of revitalising their economy. Clearly mines like Lundin's Fruta del Norte are highly profitable. They are contributing significantly to the GDP of the country. So outside of Fruta del Norte and the Mirador copper mine, they are the only 2 commercially operated mines in Ecuador. So there's significant opportunity to obviously grow the GDP of Ecuador through mining. And then ESG and community is largely what it comes back to. So again, we've been active in country for a little over 4 years. We've had these projects since 2020, locked out due to COVID, really got on the ground in earnest from 2021 onwards. What we've been able to do is forge really strong relationships with the communities. The Dynasty project is 5 kilometres from the town of Salica. We've got a workforce of 5,000 people there. Everyone that we employ is local or within the local region. We only have one expat, and he's our exploration manager. He's Chilean, 20 plus years experience in the industry, really knows what needs to be done to, explore these projects to, for what we believe could be a major tier 1 discovery. So we've got the right person leading the team over there. We've certainly got a young and enthusiastic team of geologists who are very passionate about what they're doing. In fact, the entire company is. So on to that. The board and myself Clearly, I guess a lot of experience, a number of geologists, geophysicists, I'm a geologist myself, and, Matt Carr picked up the projects or identified them at PDAC back in, 2018, 2019. So a lot of capability amongst our board and management team. And I guess what we're working towards this year is delivering a number of milestones. So Dynasty is all about growth for us. It's all about achieving that 5 million ounces through, resource extensional drilling, but also testing some of our really exciting exploration targets. We're working towards a resource update mid this year and dovetailing in some of those de-risking scoping studies, which we look to deliver at the end of this year. And then outside of that, the copper projects really is the blue sky opportunity for, our shareholders and our investors with the work that we're doing at those projects. And then the last slide just shows you a little bit about, what I believe to be our value proposition and the severe disconnect between our current market cap of about 100 million, 110 million Australian. The EV for our gold resources is about $22 an ounce. No value given to our silver. No value ascribed to the joint venture deal that we've done for Linderos or the blue sky opportunity at our Copper Duke project. And we put the Dynasty resource out in July 2023, a very different price environment to what it is now. Gold's at all-time highs, $3,100 US an ounce now. So big disconnect, and I think, things are starting to move now and a lot of inbound interest in what we're doing there and a lot for us to deliver this year. Sorry, I've run over time.
Well done. An interesting proposal over in Ecuador, a second one for us. Now, you'll like this next fellow, Jordan Alicio. Now, Jordan is a bit of a gold nerd. Would that be fair to say, Jordan? Back in the 2000s, he was introduced to the world of gold and he's never looked back. And he's managed to build a stellar career around gold and what drives it, what drives the market forces for it. So we have engaged him here today. He's here on behalf of ABC Bullion in his role as General Manager to present a talk to you on Gold 2020. So he's going to take a look back at the last 20 years in the gold market and perhaps give us some insights into what might drive the future. Don't ask him to look into a crystal ball. That's not the type of individual he is, but he knows a little bit about the things that drive gold. Please make him welcome, everyone.
Thank you for the introduction. God, that's loud. Remember high school being called a nerd, it was a little bit offensive, but now I take it as a compliment. So I am a bit of a gold nerd. I was extremely fortunate to be introduced, I suppose, to the investment case for gold in the early 2000s, around the time I moved to the United Kingdom, became a personal investor in bullion back in those days, and subsequently moved into working in the precious metals industry around 15 years ago. Prior to that, I'd stayed in traditional wealth management, hedge funds in the UK, superannuation in Australia, but gold very much became my passion in the early 2000s, and I've been really honoured to be able to work in the industry with so many fabulous people over the last 15 years and for an organisation like ABC Bullion. And obviously, today's the current mood amongst the industry is relatively euphoric or at the very least extremely positive. For all of us that have been in the industry for a long time, we've sort of ridden the ebbs and flows, the highs and lows of the last 20 years. But if you actually sort of take a long-term view or look back at what has happened, the history books really very much are going to say that what we've seen unfold in the last sort of 20 to 25 years really is a textbook bull market. So that's the US dollar gold price from 1999 through to about a week ago when I did this chart, so just before it ticked up over $3,000 an ounce, and you can see effectively an almost uninterrupted bull run through to 2011, a period of consolidation through to 2015, and then it's been almost uninterrupted upside since. And I guess when people do write the history of this bull market and some of the milestone moments that will be talked about, they are all relatively obvious and well known, but they're worth reflecting on for a moment. There was obviously the terrible events of September 11, which followed on from the NASDAQ crash of the year before. Gold was effectively, at an asset that most investors were completely shunning up until that point. The NASDAQ crash, September 11, put risk, for want of a better term, back on the menu for people. People realised that, there was, whether it be stock market corrections, whether it be terrorist attacks, things like that can happen, and that assets like bullion probably shouldn't be completely forgotten about. The next major event was obviously the crash of Lehman Brothers and the onset of the global financial crisis. For those of us that were in the market, there was a short period of time there where even the performance of gold was quite surprising. It actually fell quite a bit in 2008, just for a couple of months, before recovering and delivering a positive calendar year gain that year as the Fed cut interest rates and began to talk about implementing QE. We then had the top in 2011 and the subsequent correction through to 2015, where the Wall Street Journal, I got my marketing team to create that image of a gold brick that's got a dog's eyes on it. They ran a famous headline calling the article was titled, "Let's Be Honest About Gold, It's a Pet Rock." That was published in December of 2015 when the gold price was roughly $1,050 an ounce. It almost perfectly coincided with the end of that corrective period. Obviously, 2016 saw Brexit and Trump's first victory in his run for the White House. Gold had a nice little bump there, but actually really trended sideways for the better part of 2 years. For those that can remember, the gold price spiked on the night that Trump won the race for the White House and then subsequently fell in the months that followed. And it wasn't really until about late 2018 that it really got a wriggle on again. The markets had a bit of a wobble, yield started to fall, and gold really has been in an uninterrupted bull market since COVID obviously reignited or put the foot to the floor, and more recently Trump coming in and all of the talk around tariffs, as well as the way he's, for want of a better term, trying to redesign the world order, as it were, all of which, causing volatility in stocks, causing crypto markets to fall, creating uncertainty as it relates to the economic outlook, and certainly no doubt one of the factors that is driving or has helped drive the continued demand for gold amongst nation-state actors, central banks, you name it. So, that is the story of the last 20 years, obviously a very summarised and edited version of it. As it stands today, obviously everyone's feeling very exuberant. The price is above $3,100. It wouldn't actually surprise, and I hope no one throws any rotten fruit at me for this, but it wouldn't actually surprise to see gold pull back or at least consolidate a little while here. I was talking to my colleague Nick Frappel, head of institutional markets at ABC Refinery, who many of you may know, earlier today, and he was sort of talking, gold's probably got targets to that 3,150, 3,2 range, but it wouldn't shock to see it take a breather there. And if you sort of go and look at the charts, and I created this one last week before coming up here, it shows gold versus the 200-day moving average, and the grey area is how many dollars above or below the 200-day moving average it is, and the gold line is that gap, but expressed in percentage terms. And you can see, so I don't think this has got a pointer on it, but you can see gold's roughly 15% above the 200-day moving average right now. It has become more extended in periods in the past, in bull market runs, but at least if history is any guide, every time it runs this fast, the froth does come out of the market and it does pull back. And in terms of dollar terms, and this is going to be an important one now that the price is so high, the dollar moves we're talking about now are far more substantial, but in percentage terms, they're not. So, a $300 correction in gold now would just take a little bit of the froth out of the market. It would be absolutely nothing to fear. It would be a textbook correction in the context of what is very clearly a bull market in the metal and in the associated mining companies that are either producing or exploring for gold. In terms of the things that have changed in the gold market, or things that are worth observing and helping contextualise as we move forward, there are a handful of things that stand out. The first one is gold's relationship with real yields. And so again, I mentioned at the start, I used to work in sort of traditional wealth management, superannuation, for most of the bull market run in gold, really from the early 2000s up until about 2020, gold largely did trade with a very strong correlation to the real yield on 10-year US Treasuries. And so as a general rule, the lower the real yield on Treasuries went, the better gold performed. And so a lot of people in traditional wealth management, they were largely ambivalent about gold because they were of the view that they could get that same performance characteristics, similar liquidity, and an asset they were far more familiar with just owning Treasuries. And that, as I said, that relationship largely held through to around 2 or 3 years ago, roughly coinciding with the commencement of hostilities between Russia and Ukraine. And what we saw after that was that the relationship completely broke down. So real yields actually have gone substantially higher in the last 3 to 4 years, rather than that being a tailwind, a headwind for gold prices and leading to the metal declining. We've obviously seen the market increase very, very significantly. So that is a really important development for the market, and something to keep in mind now. If people say, well, yields are likely to rise, therefore that's going to be bad for gold, the last few years would tend to disprove that. The other, another observation worth making is obviously the importance of the ETF market. There's probably a bit of crossover between these two. So, I think one of the things Australia can be proud for, we're one of the largest gold mining countries in the world. We're also, I would like to say, a home of innovation for gold investment. The Australian Stock Exchange launched the first ever gold ETF back in 2003. And by and large, you can see that demand for these ETFs and for these products globally has effectively mirrored the rise and fall of the gold price over that period. Again, though, with the exception of the last 2 or 3 years. So a lot of people thought if ETF investors aren't buying gold, the gold price can't go up. They are the icing on the cake, for want of a better term, that's required for gold to show upside momentum. Again, the last 2 or 3 years have completely destroyed that hypothesis. For most of that period, investors have been liquidating holdings in ETFs. This has changed in the last 2 or 3 months. We're seeing inflows again. But for most of the last three years, really since about August of 2020, you've seen money come out of these products. Despite that, the price has obviously gone significantly higher. A couple of years ago, we hosted an event in Sydney called the Battle for $2,000 Gold was the title. Obviously, we're $1,000 higher, even though on aggregate, there's basically been no demand from this part of the market in that 2-year period. The next one and this is probably one of the most important things to think through as we look ahead, is gold's relationship with the stock market. So this chart's showing two things. The gold line, which is the more volatile of the two, just shows the performance of gold in US dollars versus the S&P 500 on a rolling 1-year basis. So if the number's above zero, it means gold's outperforming. If the number's below zero, it means the stock market's outperforming. And you can see that that's oscillated quite wildly over the last 20 years, as you'd expect. Gold's very clearly in the lead now on a rolling 1-year basis. It's ahead by about 15%. The more interesting line, though, is the black line, which is the 10-year relative performance between the two. So if you go back to 1998, 1999, gold had lagged the stock market by about 400%. In the 10 years that followed, it outperformed by about 600%, leading into 2011, and gold almost touching $2,000 US for the first time back then. And then in the 10 years that followed, obviously as gold went through that corrective period and equities went through one of their biggest bull markets on record, equities dramatically outperformed, and you ended up in a scenario where they had run ahead of gold by about 400% on a rolling 10-year basis. That is all being unwound now. Gold is very clearly outperforming stocks. It's broken out against a 60-40 portfolio of stocks and bonds, the kind of traditional portfolio an advisor might recommend to people. And so that is going to drive capital rotation really for the foreseeable future, not only into gold, but into what we might call proxies. So silver, certainly gold mining equities as well. So despite my earlier comments that it wouldn't surprise to see gold take a breather at these levels, at least in the short term, charts like this and data like this very much suggest that more and more capital is going to find its way into this sector in the years ahead. Obviously, central banks are a major part of the market as well. I'll jump over this though, because I know Xiaokai spent 15 minutes on this in his presentation as well, and I've got a couple of minutes to go. So if we sort of think ahead to the next 20 years and what the gold market might look like, as I see it, there are really four types of main players in the gold market. I've kept industrial uses out of this because that's by its share of overall gold demand is quite minimal. But if you look at the four main players, or pillars of gold demand, you've got central banks, as Xiaokai touched on. We are in a new world now for central bank demand. The global financial crisis changed the game. They went from 20 years of net selling to net buying. COVID, the onset of hostilities between Russia, Ukraine, and the reactions to that have only accelerated the drive towards gold. 1,000 tons a year worth of demand coming from that sector. If you look at the consumer markets, either for bars or coins or jewelry, China, the Middle East, India, other parts of Asia, there is no reason to suggest that those markets won't continue to consume at least something in the vicinity of 2,000 tons a year. So between those first two, there's 3,000 tons already accounted for pretty quickly. Your regular accumulator of gold and silver, again, there's a very strong expectation that their demand will only accelerate, particularly in a world where rates are starting to come down as they are, particularly in a world where inflation, whilst it has eased from the 8 to 9% rates we saw in the aftermath of COVID, it is still at problematic levels, typically at the upper end of central bank target bands. The last one, though, is the diversified investors. And by that, I mean the kinds of the regular person that goes to their financial advisor, even your institutional super fund or institutional portfolio around the world. For most of the last 25 years, these people have by and large ignored gold. It has not been a staple in their portfolios. But in a world where the price has gone above $3,000, in a world where there is such geopolitical risk, in a world where the returns on financial assets are likely to be substantially lower in the next 10 to 20 years than they have been in the prior 15 years, I think we're going to see more and more allocations from these types of investors, and holding gold as part of a diversified portfolio will become the norm rather than the exception. And as a way of illustrating that, or maybe highlighting an early example, was really, really pleased to see in Australia. It's nice to end with a local touch, or a local for me, given that's where I'm from, story here, in that an organisation by the name of StockSpot have become a qualified and APRA-regulated superannuation fund. They can, take anyone's money who has a job in Australia, and they have launched 5 portfolios for Australians to put their superannuation in, and each and every one of them has a roughly target 15% allocation to gold. So it is a standard part of every portfolio that every client of theirs will have exposure to. As I say, I think things like this are going to become the norm in the years ahead, rather than the exception like they are today. So thanks very much for your time, and look forward to a bite to eat. Only a minute over time.
Well done, well done. It was well worth it. It's only a minute over time, so it was well worth listening to that minute. Now, I've seen a couple of you coming in at the back there with your cups of tea, so team, that's our cue. It is afternoon tea time. I'll give you 25 minutes. We'll ring the bell, come back in. And about 5 o'clock this afternoon, we'll be breaking for our cocktail party and our welcome function. I hope you're enjoying the first part of the program of events today. I look forward to seeing you back in the room very, very soon. Thanks, everyone.